Have you ever stopped to wonder, if every country in the world is drowning in debt, who exactly is the creditor? It's a question most people never think about because we retrained to believe that government debt is normal. Inflation is inevitable, and central banks are the guardians of stability. But if that's the biggest illusion of all, what if the entire financial system was never meant to be paid back? Because it can't be. This is the story of how central banks quietly built a machine that feeds on debt. A machine so deeply embedded into our lives that we mistake it for progress. Long before the flashing tickers of Wall Street and the digital numbers in your bank account, money was something real: gold, silver, or physical goods. You couldn't just create more of it. Governments lived within their means because money itself was limited. Then came a new idea, an idea that changed everything. What if money didn't need to exist before it was spent? Back in 1694, England was running out of options. Wars had drained the treasury. So the British Crown turned to a group of wealthy financiers with a radical proposal. They would lend money to the government, but in exchange, they wanted the right to issue notes backed by that same debt. That deal created the Bank of England, the world's first central bank, and with it, a brand new concept. Money no longer had to be mined, earned, or found. It could be created through borrowing. Every new pound represented not wealth, but a promise to repay with interest. And that interest could only come from new debt. The system could expand forever, but it could never truly balance. For the next 2 centuries, the model spread across Europe. Each major empire adopted its own version. By 1913, the United States joined the club with the creation of the Federal Reserve. It was sold as a way to stabilize the economy, prevent crises, and ensure growth. But underneath the public messaging, it was a monumental shift of power from governments to those who controlled credit. Here's how it works. The government borrows money from the central bank. The bank creates that money out of thin air, literally typing it into existence. Then, the public repays it through taxes, inflation, and interest. The more governments borrow, the more money central banks can create, and every dollar, euro, or pound enters existence as someone else's debt. At first, it seemed sustainable. After all, the money was backed by gold. You could, at least in theory, trade your dollars for something real. But by the 1960s, the math stopped adding up. America was spending far more than it earned on wars, welfare, and global dominance, all financed by printing more money. Foreign countries noticed. They started demanding gold in exchange for their dollars. And in 1971, President Richard Nixon made a fateful announcement. The United States would suspend the convertibility of dollars into gold. With that single decision, the global financial system detached from reality. Money became purely symbolic, just paper, just trust. Economists call it fiat currency, but what it really means is that money exists because governments say it does. And once the anchor of gold was gone, there was no limit. Governments could print endlessly, and banks could lend 10 times what they actually had. From that point forward, every single dollar in circulation was born from debt. The results were immediate. Inflation began to rise. The cost of living crept upward year after year. Every boom was fueled by borrowed money, and every bust led to even more borrowing. When economies faltered, central banks stepped in, lowering rates, injecting liquidity, and encouraging even more debt. In 2008, the illusion cracked. The global financial system collapsed under the weight of its own leverage. Trillions in so-called assets evaporated overnight. Governments rushed to rescue banks with bailouts funded by even more borrowing. Central banks didn't fix the system, they doubled down on it, introduced quantitative easing, a polite term for creating digital money out of nothing and pumping it into the markets. Trillions were printed, yet somehow ordinary people got poorer while asset prices soared. The rich got richer because they owned the assets being inflated by all that new money. And after 2008, the debt explosion went parabolic. Global debt doubled again in a single decade. By the 2020s, it had surpassed $300 trillion. Central banks slashed interest rates to zero. Corporations borrowed to buy back their own stocks. Governments borrowed to cover deficits. People borrowed to survive. Then came 2020. Lockdowns froze the world economy, and trillions more were printed overnight. For a moment, it felt like prosperity had returned. Stock markets soared, spending rebounded. But it wasn't real. It was borrowed from the future. Inflation returned with a vengeance. Currencies weakened. And yet the only solution offered was more debt. Here's the paradox. In a debt-based system, paying off all debt would destroy the money supply itself, because every dollar is someone else's liability. If you removed the debt, you'd remove the money. The system can't be paid back without collapsing, and so it continues, forever expanding, devouring itself to survive. Today, global debt is more than 3 times the size of the world's total annual production. For every $1 of real goods or services, there's $3 of debt attached to it. Governments claim growth, but what they really mean is more borrowing. Central banks promise stability, but every solution they implement creates the next crisis. In 2000, the dot-com bubble burst. In 2008, the housing bubble exploded. And we're facing the largest bubble of all, the sovereign debt bubble. And through it all, the same pattern repeats. Each crisis transfers wealth upward. Small businesses fail, banks consolidate, and central banks tighten their grip. Ordinary citizens lose purchasing power through inflation, while the system's architects profit from every turn of the cycle. Because in this game, there are no losers at the top. Every dollar of public debt is a private asset for someone else, usually the same institutions that helped create the problem. The central banks don't serve the public. They serve the financial networks that depend on debt for survival. So where does this leave us? First, understand this. Debt isn't a flaw in the system, it is the system. Every dollar, every loan, every bond, all are part of a machine designed to expand forever, no matter the cost. Second, inflation isn't an accident. It's how the system quietly extracts value from those who hold money, shifting wealth from savers to borrowers, from workers to financiers. Third, stability is an illusion. As long as the foundation of money is debt, every fix only delays the inevitable reckoning. We are living in the end phase of a 300-year experiment, one built on promises that can be fulfilled and debts that can be repaid. When the next reset comes, it won't just change economies. It will redefine what money, freedom, and ownership mean. The question isn't if the system breaks, it's what replaces it. If you found this story eye-opening, don't stop here. Share this video, drop a comment with your thoughts, and subscribe for more deep dives into the hidden forces shaping our financial reality. Because in a world built on illusion, truth is the only real currency left.